You're listening to the Financial Source podcast on YouTube.
Welcome back to the Financial Source podcast. Today we're tracking three powerful converging forces that are really moving global markets: trade wars, tech policy, and persistent geopolitical risk.
And the immediate tension, the real question, is how central banks, especially the Federal Reserve, are going to react to this complex backdrop.
Exactly. We're seeing policy decisions that are suddenly outweighing traditional economics data points.
That's the whole conflict right now. We need to analyze what's happening with specific government actions, like the dual announcements on NVIDIA exports to China and the new tariff threats against Mexico.
Right. And plus, we'll look at why the Reserve Bank of Australia gave this surprising hawkish lift to the Aussie dollar, just with words, even while holding rates steady. These aren't just headlines, they are absolute market movers. Let's unpack it.
So we took a look at the sources you shared this week. Articles, notes, a lot of research, all focused on global policy and market risk.
Yeah, and our mission today is to cut through all that noise and really deliver the three most powerful insights. We want to show how government policy, diplomatic threats, and tech regulations are now the primary drivers of volatility.
We're calling it the policy over data moment.
It's a complete inversion, isn't it, of the traditional market calculus?
It absolutely is. I mean, historically, we'd be tracking inflation, employment, growth figures. Now we're tracking White House announcements, ministry statements, diplomatic treaties.
And there's no clearer example of that than in the dynamics around the U.S. tech sector in China.
Right. So let's start there.
We had this news this week that the U.S. authorized limited exports of NVIDIA's high-end H200 chips to some approved Chinese customers.
Which, on the surface, sounds like great news. A trade easing.
It should have been a massive relief valve for the tech sector. And, initially we did see a quick, sharp boost, but then it just faded immediately. So why didn't that relief stick?
Well, the caveat is why it didn't stick. And that caveat is the insight. This wasn't a return to free trade. Not at all. It was a highly controlled, very transactional agreement.
Transactional in what way?
The fine print stipulated that 25% of all payments tied to this specific export allowance are slated to go directly to the United States.
Wait, 25%? That's not a regulatory fine or a licensing fee. That sounds a lot more like revenue sharing.
That is precisely the question the market is wrestling with. It creates this precedent where national security policy becomes a direct revenue stream.
It completely blurs the lines between government regulation and private sector profit.
Exactly. This 25% rule essentially tells the market access to strategic tech is now monetized, and it's subject to unilateral government appropriation. That level of control is, well, it's bearish for predictability, even if the short-term news looked good.
And if you needed more evidence, just look at the reaction in Asia. The Chinese chip makers themselves actually came under selling pressure after this partial approval.
It's the definition of policy ambiguity, creating risk aversion. The market saw it not as a permanent concession, but as the government just holding its thumb on the scale.
So they're just reminding everyone who's in control.
Right. Investors read it as a reminder that the policy lever can be pulled at any moment. And that creates extreme caution. It's like being told you can have one slice of cake, but you know the chef is watching you, ready to pull the plate away.
That uncertainty is worse than a clear no.
Much worse.
Which brings us right to the other side of the trade coin. Using tariffs as diplomatic pressure. We saw President Trump threaten Mexico directly with a 5% tariff.
And this was over a water treaty, of all things. The accusation is that Mexico is violating the treaty by not releasing enough water.
This is a dramatic escalation in how trade policy gets weaponized, isn't it?
It's a huge escalation. We're not talking about import duties on steel or aluminum anymore. We are linking a seemingly regional resource dispute water rights directly to national trade policy.
And the message there is that anything deemed a national priority can now be punished with tariffs.
That linkage is the key insight. And it's not an isolated event. We also had warnings aimed at Canada that severe tariffs on fertilizer are still on the table.
So every commodity trader out there is now watching diplomatic news, not just crop yields.
And what's so bizarre is that this is happening at the same time as attempts at trade easing elsewhere.
Right, like the work on a new trade deal with India. And U.S. lawmakers are pushing the administration to ease tariffs on Japan.
Which is clearly about strategic alignment against China.
So, just to recap, we have tariffs for resource disputes, tariffs for geopolitical alignment, and now revenue sharing on tech exports. It's an incredibly confusing environment.
And it perfectly explains why Chinese Premier Li spoke out. He noted that the mutually destructive consequences of all this are becoming clear, and that calls for free trade are growing louder.
It reinforces the core theme.
Yeah.
Policy is just driving everything right now.
So if government policy is driving trade, let's look at how the central banks are coping. Let's move to the monetary sphere.
Okay, so the Federal Reserve is basically playing the waiting game this week. What does that mean for the dollar and gold?
It means suspended animation. I mean, the U.S. dollar has been largely unchanged, just moving sideways. Traders are glued to the calendar.
Waiting for the Fed's updated rate projections.
Right. And that midweek announcement, the market knows those projections will be influenced by all the geopolitical risk and trade uncertainty we just talked about, not just, last month's CPI number.
Gold is following the exact same pattern, just indecisive. A holding period.
But while the behemoth in Washington, D.C. waits, we did get a major nuanced surprise from the Reserve Bank of Australia.
Yes, and this gave the Aussie dollar a noticeable lift, which seems counterintuitive since they didn't actually raise rates.
This is a fantastic example of central bank communication driving markets. They're using words as a weapon.
So what did they do?
Well, the Reserve Bank of Australia held the cash rate steady at 3.6%, which everyone expected. But Governor Michelle Bullock's language, it was very specific and very hawkish.
And for the listener, what does hawkish mean in this context?
It means they leaned hard into the idea of future tightness. Governor Bullock explicitly stated that rate cuts are not needed. And then she said she does not foresee cuts in the foreseeable future.
Wow, that is a profoundly strong signal.
It is. Usually central banks want to maintain flexibility. They say, we're data dependent. By ruling out cuts for the visible horizon, she effectively tightened financial conditions without spending a rate hike.
So the language alone tightened things up. By taking lower rates off the table, the market had to price in a longer period of higher rates, and that's what drove the Australian dollar up.
That's the key takeaway. It's all about guiding expectations. That strong forward guidance, which is a policy tool, was read by the market as a mild tightening bias.
And it stands in stark contrast to the indecisiveness we're seeing from the Federal Reserve.
Absolutely. Meanwhile, you've got the euro and sterling just range-bound, waiting for their own policy cues from the Bank of England.
And it's worth noting the Japanese yen steadied. That's after all the volatility from Monday's big earthquake and the tsunami warnings.
Right. Once those advisories were lifted, the yen found its footing, which confirms that in the short term, a physical risk can overwhelm policy risk, but usually only for a moment.
Because lurking underneath all of this is that persistent, massive risk premium from geopolitical disputes.
Which brings us to our third major converging force.
Geopolitical risk is the permanent backdrop for all these market moves. The Russia-Ukraine conflict is still this huge variable.
Absolutely. It's injecting uncertainty into commodities, sovereign debt, everything.
Yeah.
President Zelensky's recent talks in London really highlighted the core tension.
There was small progress, but the hard line is still there. Ukraine cannot concede territory.
Which means the conflict is destined to drag on. And that means the market's risk premium has to be maintained.
The Western response was strong, though. European Commission President von der Leyen reaffirmed unwavering support. The UK agreed to intensify pressure on Russia.
That unity is a powerful policy signal. But the really crucial development here, and this is a potential game changer for sovereign risk globally, is the report about Britain and the EU nearing an agreement on the frozen Russian assets.
Right, they're talking about releasing them.
We're talking about releasing a massive 200 billion British pounds.
Wait, 200 billion? That figure is staggering. Why hasn't this caused a massive panic yet? And what does this mean for every non-aligned nation holding euros or US dollars?
This is a tectonic shift. It's a shift in the definition of sovereign immunity. The money is specifically earmarked to fund Ukrainian reconstruction.
But the mechanism itself is what's so unprecedented. For a G7 bloc to just seize and repurpose another country's central bank reserves.
The moment that happens, it changes everything. Central bank reserves are supposed to be the safest, most protected assets in the world. Using them as a diplomatic weapon fundamentally changes how every government views holding reserve currencies.
Exactly. It introduces a severe long-term risk to the perceived safety of holding euros or US dollars.
Precisely. Countries that are politically neutral or maybe adversarial to the West now have a very compelling $200 billion reason to diversify away from Western assets.
Towards gold or other assets that can't be sanctioned.
This one policy action could have implications that reverberate for years.
And on the diplomatic side, Zelensky also pointed out that China is not interested in forcing Russia to end the war.
Which just reinforces the expectation that this commodity uncertainty will continue. And that uncertainty is why crude oil is stuck in a range.
There's this constant tension from the conflict, but global supply has stabilized a bit.
Right. We saw that counterbalance when Lukoil's West Quantitu crude flows resumed in Iraq.
Yeah.
It provided a small but necessary dose of supply certainty.
Still, risk appetite in Asia softened, which is part of why copper dipped.
And that softness ties right back to the selling pressure on Chinese chip makers after the NVIDIA news. It just shows how interconnected a single U.S. policy decision can be across the entire globe.
We should also just briefly note that tensions remain high in the Middle East, with Israel confirming strikes in southern Lebanon. It's another persistent risk-keeping caution baked in.
So let's bring it all back home. What does this all mean for you as you prepare for the week?
Well, U.S. equities began the week softer. It feels like a cautious, tentative tone, not outright risk-off selling. Everyone is just waiting for the Federal Reserve.
And that cautious tone is absolutely warranted because, as we've established, policy decisions are proving far more potent than economic data right now.
We're talking about everything from chip export conditions to these frozen asset debates to the nuance of a central banker's language.
All of it is creating this FX sensitivity.
And FX sensitivity just means currency traders are ignoring inflation reports and employment numbers. They're watching diplomatic announcements and government threats instead.
It undeniably reinforces this idea that artificial intelligence policy, technology regulation, geopolitical risk, these are now fundamental, inescapable macro variables.
They link technology directly to trade, just as Chinese Premier Li noted. We're in a world where a carefully worded statement can create more market movement in an hour than a month of inflation reports.
So here's something for you to consider as you digest all this.
Yeah.
Given how sensitive markets are to these policy decisions that link seemingly disparate issues like water treaties to tariffs or tech access to a revenue share, what's next?
What other policy-driven geopolitical disputes, things that seem minor or regional today, could quickly escalate and become the next major global market risk? It's a risk landscape defined by unpredictable policy shifts, and the next threat could come from the most unlikely source.
That was a dense policy-driven session, but thank you for diving into the details with us today.
We appreciate you tuning in. Join us again soon on the Financial Source podcast for the next essential discussion.